Let's work through a labor variance example problem. So the problem says Walker Manufacturing's standard labor cost of producing 1 unit is 2 hours at the rate of $15 per hour. During April, 50,000 hours of labor are incurred at a cost of $14.75 per hour to produce 26,000 units. So we need to compute the total price and quantity variances for labor. Before we do that, let's define our terms. So we have actual hours, actual rate, standard hours, and standard rate. So our actual hours, how many hours did we actually incur of labor during April? That's our 50,000, right? It says 50,000 hours of labor are incurred. The actual rate, how much are we paying per hour? Well, that's our $14.75. Now, standard hours. This one takes a little bit of calculations. So, we expected 1 unit to take 2 hours, and we produced 26,000 units. So, based off of that, we would have expected to have 52,000 hours of labor this month. So that's our standard hours. Standard rate, what did we go into the month thinking that we were going to be paying per hour? That's our $15. So now that we have all of those, we can now figure out these variances. So, if we take our actual hours times our actual rate and subtract it by our actual hours times our standard rate, we'll get our price variance. And then if we take our actual hours times standard rate minus our standard hours times standard rate, you'll notice that the variable that changes there are the hours, or the quantity, so that's our quantity variance. And then we can use our price variance and our quantity variance to figure out our total variance. So now let's plug in our numbers. So actual hours times actual rate. So 50,000 times 1475 equals 737,500. So that's our actual hours times actual rate. That's how much we truly spent on labor during this month. Our actual hours times standard rate, that's 50,000 times 15, that's 750,000. And then our standard hours times standard rate gives us 780,000. So let's first figure out our price variance. So we subtract those two amounts, and that gives us 12,500. And then we have this F. The F stands for favorable. What makes this favorable? Well, we expected to spend $15 per hour. We truly spent $14.75 per hour. So we're saving money, and so that's what makes that favorable. Now our quantity variance is 30,000, and once again this is favorable. What makes this one favorable? Well, we expected to need to have 52,000 hours of labor this month. We truly only needed 50,000. So we didn't need as much labor, so our quantity variance is favorable. Now we can use both of those to find our total variance. Since they are both favorable, we will add them together to get 42,500 favorable. If one was favorable and one was unfavorable, we would subtract them and keep the sign, keep the favorable or unfavorable of whichever one was larger.